One that's registered for the webinar and is attending comes for a number of different reasons. Some of you wonder, is Social Security, can it really be increased? Others are interested, are there alternatives to the stock market or banks or bonds to get higher income, particularly in retirement? And a number of you are wondering, can I really truly reduce my taxes? And can I legally reduce my tax even to zero and recover taxes paid last year? The answer is yes. You're going to hear some truly unique material based on my 50 years of studying the world of money. So let's jump right in. The title of today's webinar, although many topics are covered, is Pay Zero Federal Taxes, just like President Jimmy Carter did in 1976 and Amazon did in 2017 and 2018. First of all, who is Dr. Wong? I got my PhD in economics, UC Berkeley in 1974. I passed the national US CPA exam in 1979. Everyone takes the same CPA exam, unlike the bar exam to be a lawyer, which can vary from state to state. When I took it, only 4% would pass all four parts of the 3-day exam. I was a guest expert on taxes on over 400 TV and radio shows, and I set audience response records on 50 plus radio and TV stations in California. For 8 years, I wrote the only column on money for the community section of the Arizona Republic, the largest daily newspaper in Arizona. And my research on investments, the economy, and taxes was distributed to 2,100 newspapers in the US. But more importantly, I'm not an ivory tower professor. I've started 11 small businesses, everything from hotels to almond farms to mortgages to all sorts of stuff. And bought my first hotel in 1985 in San Diego and turned it into a celebrity hotel where Whitney Houston, famous athletes like Marcus Allen, the Hall of Fame running back for the Los Angeles Raiders and the Kansas City Chiefs, would stay, because the one thing I could offer them that they couldn't get at other hotels was total privacy. But let's jump right in because it's all about what can this webinar do to help you in your financial situation. I consider my clients to be my extended family. My parents came from China and were cheated by Wall Street investment brokers. I vowed to educate Americans to maximize their retirement income, minimize stock market risk, reduce or eliminate taxes, be able to afford medical and long term care expenses, and be able to afford your kids, grandkids, and yourself to enjoy bucket list dreams. Is it really possible to legally pay zero taxes? March 1980 was my first media appearance. It was 2 hours as a guest expert on the CBS radio station, KCBS in San Francisco. I had no idea. A month later, the station and I were stunned. I'd set an all time response record with over 3,000 letters and phone calls. And here's why: it wasn't about me, it's about what I could do for the folks listening. I showed how Jimmy Carter paid no income tax in 1976, the year he was elected president, how Governor Reagan, that was the governor of California, and in 1980 succeeded Jimmy Carter as president of the United States, how Governor Reagan, there were years where he paid no California income tax. And more importantly, I said at the end of that 2 hour radio show, the law in America should apply to everyone. So whether you're president of the United States, governor of California, or just a normal person, whether it be an engineer, a nurse, or school teacher, or a truck driver, you should have the right to follow that same law and be able to save lots of tax as well. Let's just go right into the numbers. Everything I do is based on research, not conjecture. And that's why my business card says I'm a tax advisor and financial educator. I'm not a salesperson. And as an educator, I've got to back up everything that I say. In 1975, Jimmy Carter's adjusted gross income was 136,926. In 1976, it dropped by over 80,000 to 54,934. In 1976, if he had nothing else, meaning no extra tax credits, he would have owed $11,675 of federal tax. But due to tax credits, the investment tax credit that he got on over 200,000 of peanut processing equipment. Remember, Jimmy Carter's family business was a peanut farm and peanut processing in Georgia. Because of those tax credits, he owed zero federal tax in 1976. And he had excess tax credits, so he was able to recover tax paid in 1973, 3 years before he got elected president. Now, this caused a problem for Jimmy Carter. It was politically embarrassing. He got a $70,000 book advance check in early 1977. He asked the IRS, "Can I reflect that 70,000 in my 1976 tax return so I owe little tax?" The IRS, of course, said, "Absolutely not. You didn't receive the check in 1976, so you couldn't have cashed the check in 1976." So guess what? He owed zero tax in 1976. He recovered tax paid 3 years before he got elected president. He was so embarrassed, and he made a $6,000 donation to the IRS. But truly, Jimmy Carter had nothing to be embarrassed about. The depreciation rules, the investment tax credit was put into the tax code when John Kennedy got elected president because we had a severe recession and it helped kickstart the economy. And when businesses buy more equipment, the workers become more productive. They hire more workers, and the workers, because they're more productive, earn higher wages. So there's nothing to be embarrassed about. But it's not just Jimmy Carter. 60 giant corporations paid zero federal income tax in 2018 on a total of 79 billion in profits, and they were able to recover 4.3 billion of taxes. Now, I think you recognize some of these corporations. I'm just going to pick 6 well-known corporations that paid zero federal income tax in 2018. Amazon. Amazon has made their founder, Jeff Bezos, the richest guy in America and potentially the richest guy in the world. Netflix. During the coronavirus pandemic, when people were locked down in states such as Michigan, California, New York, New Jersey, people watched a lot more TV, and Netflix was a favorite choice. General Motors, IBM, John Deere, that makes the green equipment, the farm machinery, and Berkshire Hathaway, Warren Buffett's holding company that controls a controlling interest, or he owns a whole company for at least 60 or 70 companies. So everyone recognizes these giant companies. They did not cheat, they simply followed the law. And again, you have to ask yourself, are they better served instead of using tax money to the federal and state governments, which are quite often wasteful, or are they better off hiring tens of thousands of employees, which is what Amazon, Netflix, General Motors, IBM, John Deere, and Berkshire Hathaway have done? So thousands and tens of thousands and hundreds of thousands of people collectively now have jobs just from these 6 companies. So when I give live seminars, people laugh when I say, "Okay, you're 65 years old, sir. When did you first get a job where they took taxes out of your withholding?" And they typically say, "Well, I started working maybe when I was 15 or right out of high school." So I said, "Please show me your presidential medal that they gave you for paying taxes for all these decades." And of course, they laugh. Actually, the average person probably pays more in federal income tax than some of America's biggest, most profitable corporations. Let's take Amazon as an example. 5.6 billion of US profits in 2017, and they paid no federal tax. In 2017, Amazon bought Whole Foods for 13.7 billion. Now we know the nickname, and I know some of you probably love shopping at Whole Foods, but their national nickname, due to their high prices, is Whole Foods, means whole paycheck. If you watch the webinar to the end, you'll discover how I, with one of my companies, will save Whole Foods lots of income tax, potentially as much as $10 to $20 million this year alone. Now, there's a switch in mindset. Instead of fear of the IRS and the IRS shaking you down for every last penny, how about let's switch around and where you're getting tax refunds potentially from the taxes you paid in 2020. Now, people have no idea the impact of taxes. If you look at the tax foundation, they find when you add up federal, state, local taxes, not just income tax, it's your real estate tax, it's your sales tax, it's your phone tax, it's all sorts of taxes. Taxes actually consume more from a family typically than housing, clothing, and food combined. The top 10% of taxpayers pay 2.5 times the total tax of the bottom 90%. We would have a tax revolt if the government came to the top 10% and said, we're going to move in 2.5 times 90. We're going to move in 18 plus people that are total strangers. And for the rest of their lives, you're going to have to buy more houses or rent more apartments, buy more cars for them, buy more clothing, and you're now responsible to cover all their expenses for an extra 18 to 19 people. We'd have a tax revolt if that occurred. So people, a lot of politicians fool the public. They say the more successful people don't pay a lot of taxes. It's not true. The top 10% pay 2.5 times the total taxes of the bottom 9% of taxpayers. Now, only about 45% of taxpayers actually pay federal tax. Now, they may pay Social Security, Medicare taxes, but they don't have high enough income to actually pay federal taxes. In fact, they can get money back, sometimes thousands of dollars every year through the earned income tax credit. Now, we're at the tipping point. If only 45% of Americans actually pay federal taxes, what about the rest? It's very easy to say, just give me more, Mr. Government. Give me more free stuff because I don't have a stake in the game. If only 85 million of Americans pay federal tax, it's so easy for the rest to say, well, let's just raise the tax on the rest. Here's a favorite slide of mine of a couple on welfare. They look like they're able-bodied where they could be working. And the tagline is, you work hard so they don't have to. In California, total waste, there's at least 1 billion in fake California unemployment claims paid to prisoners, people in prison, including famous murderers like Scott Peterson. About 2 weeks ago, I rechecked the research, and now California admits it may be up to $13 billion of fake California unemployment claims paid to prisoners. That's how wasteful government is. You know why? Because it's not their own personal money. If it was their own personal money, believe me, they would double check. Who is this person filing a claim? And it'd be easy to find out, oh, they're in prison for murder, rape, armed robbery. Of course, it's a scam. David Hines in Florida bought a Lamborghini. He stung us taxpayers with $4 million of fraud on the payment protection program. Here's what I believe. You, your spouse, your kids, and your grandkids, you deserve that hard-earned money a lot more than prisoners in California as scam artists across the country in Florida. So why is it that Americans don't save lots of income tax? Well, I passed the National CPA exam in November 1979, so I'm familiar with all the major tax laws that have occurred since then. The Tax Reform Act of 1986 targeted tax shelters and eliminated major tax saving strategies such as the 10% investment tax credit. In 1981, our mortgage interest rates on a 30-year mortgage were 18%. The prime rate was 22.5%, and small businesses that hire about 60 to 70% of all new employees had to borrow 3 points above prime. So they're borrowing at 25%. At that time, due to the severe recession, there was a lot of bartering. We had barter clubs that sprang up in local cities, counties, states, and nationally. I'm a printer, but I don't have customers due to the severe recession. Then I've got a plumbing leak. So I find a plumber and I do some printing for him. He fixes the plumbing leaks, but we don't exchange cash. It's a barter. And so none of the transaction was taxed. At that time, the federal government figured that at least 10% of the economy was underground. They said, we can't let it go to 20 or 30% like it is in certain European countries. So they said, let's turn anyone that prepares taxes, including CPAs, into a quasi agent of the IRS, and let's scare the taxpayer. Let's put severe penalties on any tax preparers. You can see some of the penalties here. I could go on for slide after slide where a penalty could be up to 75% of the income they made from the client, or even a $500,000 fine, or even imprisonment. So when you look at the bottom line, is your tax preparer CPA more worried about their penalties or losing their license, or saving you lots of taxes? And then there's the fear of the public of an audit. We all know that fear when you get that brown envelope from the IRS in the mail. Turns out at least 25% of Americans are afraid of an IRS audit. Among those over age 65 or above, a third fear being audited during their lifetime. And then this is on the taxpayers. Most of them look for the cheapest way to do a tax return or do it themselves with TurboTax, and they're unwilling to pay for major tax planning. Now, this is the biggest myth about saving taxes. People say, and if you read the consumer magazines or money magazine, they say, contribute as much as you can to an IRA or a 401k, or if you work for a nonprofit, it's a 403b, or a federal employment, it's called the TSP, the Thrift Savings Plan. The way it works is out of your wages, you can contribute up to a certain maximum every year. You get to deduct it and you save a little tax that year. However, it becomes a ticking tax time bomb if you were to look at the overall picture. What do I mean? Let's give an example. Over the decades that you work, you're lucky enough to deposit 300,000 to your IRA and 401k, maybe 5,000 this year, 6,000 this year, 8,000 another year. At 65, you rode the stock market roller coaster through the crashes and the booms, and luckily you have $1 million. Now, when you start taking that 1 million out to spend it, particularly in retirement, you get no tax break. It's taxed as ordinary income, just like if you pull 50,000 out to spend in the first year of retirement, that 50,000 is taxed just like it's 50,000 wages, because really it is deferred wages. Now, let's suppose you don't need to spend the full million because you've maximized your Social Security, as we'll talk about, and maybe you're even lucky. Maybe your spouse was a teacher, and that teacher, your spouse, gets an old-fashioned government pension. So now you don't have to spend the million and distribute it in retirement. And so 10, 15 years later, it becomes 2 million. Now that fully 2 million is taxed, you've already heard with the new Biden administration, they want to raise taxes dramatically. And so you pay 40% in tax. 40% of 2 million is 800,000. Now let's look at the numbers. Over your lifetime while you're working, you deducted 300,000. And maybe if you're in a 1/4 tax bracket or a 20% tax bracket, you save 60 to 75,000 total tax. But now that 2 million is trapped in a tax deferred IRA, 401k, 403b, or thrift savings plan. And now when you take the money out, or if a drunk driver hits you and your spouse and you're dead, that 2 million's got to be distributed. Obviously, when it hits your kids, that 2 million split between two kids, each gets a million. It obviously pushes them in the highest tax bracket. So the federal bracket will be at least 40%. So each one of them lose 400,000 tax. And certain states like California, it's 13.3% at the highest level. They'll lose another 133,000. So if each is lucky enough to inherit a million, they may actually net after taxes less than 500,000. The IRS likes this leverage. You've built a ticking tax time bomb. So how do we get out of it? We get out of it with the Roth IRA. Now, except for the coronavirus year of 2020 and through the first half of 2021, normally I would give 40 to 80 live seminars every year. Thousands would come. I'd see hundreds would come in for the free strategy session, and I keep track of the data. Only 2% of those that I've seen in the last 10 to 12 years have 30,000 or more in a Roth IRA. The reason is twofold. Folks can't stand the pain of not getting the immediate tax deduction by contributing to a traditional IRA or a 401k. Or later in life, folks can't stand the pain of converting 100,000 that they've accumulated in their traditional IRA 401k to Roth IRA. Because if you do a Roth IRA conversion, it creates 100,000 of immediate taxable income. Now, let's just talk about some of the Biden tax plan. You can read fast or thin. I can talk, but he wants to raise taxes at least $3.5 trillion. And it's really a falsehood when they say, when Biden says it only affect people that earn 400,000 or more, or even millionaires. No, if you raise the corporate income tax rate, guess what? Corporations will just raise the prices of the goods and that they sell to consumers. And so the average consumer winds up paying high in prices and they pay the increase in taxes. If they get their way with the Biden tax plan, when you add federal and state and city taxes, the total tax rates to successful people in California would be 62%, 60% in New Jersey, 58% in New York State, and in New York City, because they've got almost a 4% city income tax, 62%. If you notice the news or Google it, that's why people from California, New Jersey, New York are leaving to low or no tax states such as Florida or Texas or Nevada, where there isn't a state income tax. Now, we could go through all the ways he wants to raise tax, but we're just going to move on. When you come into the strategy session, the main thing you want, whether your family taxable income is 100,000, 150,000, 200,000, you're really lucky. Maybe your spouse is a physician or a dentist, and maybe your family taxable income after all deductions is 300,000. All you want to know is whether I'm paying 10,000, 50,000, 80,000 a year in tax. Dr. Wong, can you help me reduce it in half or even eliminate it to zero? Legally, straightforward. The answer is absolutely. I've been doing this for 40 plus years. Again, one thing that just came out of the news just in the last week, the Biden tax plan wants to double capital gains tax. Now, this is going to have an impact. Let's suppose you inherited a house in San Francisco. Your parents paid 80,000 for it 40 years ago. Now it's worth $1.5 million. You inherit it. And guess what? With the so-called step-up in basis, you could sell it the next week for $1.5 million and you wouldn't pay any capital gains tax. Under the Biden tax plan, they want to tax you from what your parents paid for it, which is 50,000, to the $1.5 million it's worth now. So it's gone up 100-fold, and they want to tax you on that, except they want to double the tax rate on it. What do you think is going to happen to housing prices in high price areas like the East Coast and West Coast when the people are going to lose 40% or more of the gain from their real estate? Obviously, it's going to put downward pressure on houses. Now, if you want to protect against higher taxes, whether it's assets you inherit that you can sell, whether it's you want to do a Roth IRA conversion, you want to convert 200,000 of the 500,000 you've saved in traditional IRAs and 401ks to Roth, and therefore creating 200,000 more taxable income, or just you and your spouse have high-paid jobs or net profits from your business, just call me. Call me at 480-706-0177. I'm the only one that picks up that phone. You can leave a voicemail in off hours, and I'll get back to you. And we'll schedule a time, or you can go to my Calendly.com link and schedule a time. And we can spend up to 45 minutes covering anything you want in the field of money, and there's absolutely no charge. And if we decide after that first 45 minutes, we need to get together again, normally you come into my office for up to 2 hours, no charge, in Tempe, Arizona. Now let's go to Roth IRA conversions. When I grew up in rural Illinois, I heard a lot of the neighbors and townspeople say, the Chinese say a picture's worth 1,000 words. I don't know if we deserve that credit. I've checked with talks I give to senior communities where people have moved in from all over the country. They've heard that same saying, no matter what state they came from. So let's take credit for it. But basically, there are two worlds: the tax deferred world, traditional IRAs, 401ks, 403bs, and it's a ticking tax time bomb I've already talked about, or the Roth IRA. In a ticking tax time bomb, guess what? Your traditional IRA, 401k, 403b, the more you have in it, the more taxes you pay. If you convert to Roth, guess what? It's tax free no matter how much you earn for the rest of your life, for the rest of your spouse's life, and for the first 10 years that your heirs get it, which are typically kids or grandkids. There was the Secure Act, officially passed December 27, 2019, started taking effect January 1, 2020. It increased a year when one is forced to take what's called a required minimum distribution from your IRA, and it raised it from 70 and a half, which had been the rule for decades, to 72. There is a proposal in Congress to raise it again to 75. It abolished the Roth IRA, giving 3 generations of unlimited earnings without tax. Prior to the Secure Act, once you got money into the holy grail of tax planning, the Roth IRA, no matter how much you earned, there's no tax for your life, for your spouse's life, for your kid's life, and your grandkids' life. But now it's limited because of the Secure Act. Once you get money into an IRA, a Roth IRA, suppose you get 500,000 into it. And now, before you get hit by a drunk driver, you've got $1 million in it. There's no tax on the $500,000 gain. And then by the time your spouse dies, there's $2 million in it. There's no tax on the gain from the $1 million she got from you to $2 million. Then she gives it to your 2 kids. Each of them gets $1 million. And then 10 years later, each of them has doubled it from 1 to 2 million, or a total of 4 million. There's no tax. But at the end of that 10 years, each of your kids has got to distribute the 2 million, hits their bank account or their money market account. And from that time, anything they earn, whether it be bank interest, bond interest, stock market dividends, short or long-term capital gains, now they're taxed. Well, that's tremendous. You started with 500,000 Roth. Eventually it became worth a total of 4 million to your kids, and there's no tax on that gain. That's why it's the holy grail of tax planning. Now, some of the Roth IRA rules. To have unlimited tax on earnings, there are 2 rules. You must be at least 59 and a half, and you have had to have your first Roth IRA at least 5 years before your first withdrawal. So here's what I suggest. If you're not sure whether the Roth IRA strategy is right for you, go to your credit union or bank and open up the smallest amount of Roth that's possible, either from your annual contributions from your earning, maybe it's only $500, or you do a Roth IRA conversions of 500 in your traditional IRA. Now you've started that 5-year time clock going. And now 5.5 years later, if you convert 500,000 from your 401k to your Roth IRA, you've already fulfilled the 5-year rule. Now, people say, what if I have an emergency? I deposit 100,000 to Roth IRA, or I do a Roth IRA conversion of 100,000, and then 2 years later, I've got an emergency and I need 10,000. You can always pull that out. You can pull out the whole 100,000 because you've already handled the tax issue on it. However, for you want your earnings to be tax-free, you got to follow those 2 rules. 5 years from the time you started your first Roth IRA, and you got to be at least 59 and a half. Now, here's another great benefit. For money in a Roth IRA, no required minimum distributions are required. So now you avoid the 50% penalty. If you had a traditional IRA or 401k, once you turn 72, you have to start withdrawing a certain minimum amount every year. And it's so easy to mess up, particularly in the first year or two. And if you're supposed to pull out 20,000 and you didn't, the IRS hits you with a 50% penalty, and that 20% is still taxable. And now you lose probably 70 to 80% of that 20,000. You avoid that danger on Roth IRA funds. Here's a case study. Now, this is a big number, so we can cut it in by 10% or 20% for a lot of folks out there. But this is a big client, very successful. he saved about 10 to $15 million of financial assets. And he's about 3.5 million in a traditional IRA. Now, I'm suggesting that he converts 1 million to Roth IRA. He says he can earn 10% on that money. So if it's a traditional IRA and he earns 10% of 1 million on a traditional IRA, that'd be 100,000 a year. And in a 40% tax bracket, he'd be paying 40,000 a year of tax. But over the next 30 years, that'd be 30 years times 40,000 a year of tax, that'd be 1.2 million. By doing the Roth IRA conversion, he saves 1.2 million of tax. Now, is there any logical reason why anyone wouldn't want to save 1.2 million of tax? Now, how does a Roth IRA affect your Social Security retirement income? If you eventually have lots of money in a Roth IRA, you can now choose investments that have a higher return on investment or rate of return because you are not worried about taxes. With higher cash flow, you can now wait until age 66, 67, which are typical full retirement age for Social Security, or ideally wait until 70 to get the maximum Social Security income. In 2017, 18, and 19, twice a year as a public service, I would do seminars for federal retirement employees who worked at the Veterans Administration, the Social Security Administration, or other federal agencies. And what I explained when I did a composite, I said of 3 older single women, a nurse, nurse practitioner, and a pharmacist, I found that waiting till 70, instead of taking Social Security at 62, they would get 20,000 a year or more. So basically, it was $1 million decision. And let me explain. At 70, they would get 40,000 a year of Social Security compared to 20,000 at 62. Now, for ever since the 2008 stock market crash, when interest rates were lowered to the lowest level of our lifetime, our parents' lifetimes, our grandparents' lifetime, anything that pays interest was super low. You could average only 2% loaning to Uncle Sam on a 10-year treasury bond. And the average dividend yield for S&P 500 companies for the first 20 years of this century, starting January 1, 2000, was only 2.02%. So let me ask you this. What's easier, saving an extra $1 million from age 62 to 70 and taking that $1 million times 2% to generate 20,000 in your retirement income, or waiting 8 years from 62 to 70 where you get 20,000 more Social Security income? Obviously, it's a lot easier to wait 8 years because most people can't save $1 million in a lifetime of work, let alone in only 8 years from age 62 to 70. Again, I give a 2-hour seminar regularly on Social Security strategies. I give a 2.5-hour seminar to federal employees on understanding their federal retirement benefits, which includes their FERS, Federal Employee Retirement System, pension, and I understand the Arizona State Retirement System rules for teachers or anyone who's a part of that retirement system. So again, I know you've got lots of questions. Just call me at 480-706-0177 to book a 45-minute talk where we can talk about how to maximize your Social Security and other retirement income and also reduce taxes. Or you can go to my Calendly.com link and book your time. And please, based on the April 10th webinar, the first one I've done for this group, I noticed that some of the people that booked the Calendly.com link were not there when I called them. I understand life occurs, but if you can't make the original time, just call me is the easiest way and tell me, Dr. Wong, I couldn't make it on Monday at 11 a.m. I had something came up and I had to move it. Can we move it to Thursday or Friday? All you have to do is just call me and we'll find a time that works. Now, how do you eliminate the tax on a Roth IRA conversion, or just that you're lucky enough to have high income? There's the one strategy that is the most powerful tax reduction strategy in our tax code, and it has to do with solar business investments. Here's what happened. The Energy Policy Act of 2005 was renewed twice most recently in 2015. But then we had an emergency 2-year extension of the solar tax credit, and this was passed December 27th, 2020. And the solar tax credit for 2020 was 26%, and then it was scheduled to drop to 22%. But now there's an emergency 2-year extension for 2021 and 2022. It stays at 26%. Now, there's over 2 million people that have put solar on the rooftop. If you own your system, you get the same solar tax credit. If you lease the system, the person that owns the system leasing to you, they get the tax benefits. But your rate of return is simply lowering your electric or utility bill. We're not talking about that here. We're talking about solar business equipment that's leased out to giant food companies like Safeway, like Kroger, like Cisco, the giant food distribution company that does 55 billion a year. So now your rate of return is you get income from your power produced, typically over a 10-year lease, and at the end of the 10 years, you get your original investment back to you. You don't just get the tax credit, however, because this is business equipment. You also get something called Section 179, which allows you to deduct about 87% of the cost of the equipment in the year you place it in service, even if you place it in service or October or November of 2021, instead of having to depreciate it over 10 years. And it's been in the tax code since 1958. 45 years ago, the limit was you could only deduct 5,000 of business equipment a year. Before the Trump tax law was 500,000, and after the Trump tax law, $1 million or more each and every year. So here's how it would work. A reefer in the food industry is a 1-ton physical weight refrigeration unit that attaches to the front of a food trailer. And it puts cold air into the frozen food area, and most of the food trailer is meat and dairy or vegetables that's got to be cooled to 37 degrees, just like your refrigerator. So in a leasing program, investor puts up 60,000, the end user puts up 25,000, and it takes my company the full 85,000 to manufacture a reefer. You earn 7%, and your security is a UCC filing acts like a first mortgage and deed of trust on a real estate, such as a rental house. A lot of people have never done equipment leasing. They don't know what a UCC1 filing is. UCC stands for Universal Commercial Code, but here's how you get it. Think of the pink slip you have on your personal car. If you bought a car for 30,000 and you put 10,000 down, your pink slip would be in your name. You own the car, but it will have somewhere in the pink slip would say you owe 20,000 to whichever bank or car company, finance company that lent you the other 20,000. So everyone has a pink slip on their car, so we're familiar with it. Now you get 10 years of earnings, 7% or 4,200 a year, but we have depreciation. If you decide you don't want to take the big write-off up front with Section 179, you depreciate it, and guess what? You have more depreciation every year over the next 10 years than your income, so you don't pay tax on your income. Now, if you're in a 30% tax bracket, earning 10% and losing 30%, that would net 7%. But if you're not paying any taxes, it's the equivalent of making 10%. Now, what if you use the solar tax credit, and let's not count depreciation or Section 179. The way it works, you have to take half of your solar tax credit, which in this case is 15,600, you decrease it from your cost basis, and then you've got 15,600 of solar tax credit, and your cost basis is 52,200. And again, you can depreciate over 10 years, or you can take that deduction in the year it's placed in a service. Now, normally you couldn't. Wall Street can't allow you to do that because they pool hundreds or thousands of people, and it's deemed a passive investment where you can't take these deductions unless you have offsetting passive income. But with our strategy, you own the whole solar system. You own the whole reefer, you own the solar panels that cover the entire top of the food trailer, you own a momentum generator that generates energy underneath the food trailer, and you own lithium ion battery packs where we store the energy. There's 7 ways to qualify, and then now you can take Section 179. Now, if you just use the 26% tax credit, it would reduce your cost from 60,000 to 44,400 due to the 15,600 tax credit. Your income's 7% of 60,000 or 4,200, and so you're really earning 9.46%. So bottom line, solar reefers generate a much better tax savings and a larger cash flow than stock market dividends, which are 2.02%, or lending to Uncle Sam. A year ago, when the pandemic occurred, you could only get 6/10 of 1% interest loaning to Uncle Sam. So if you bought a 10-year treasury bond for 100,000, you would only get $600 of interest a year. Most bank accounts pay only 1/10 of 1%. If you had 100,000 there, maybe they give you $100 of interest at the end of the year. You can't live on that. You can't have a happy retirement, but you can if you're getting 7% or effectively 10% when you count your tax savings. Let's go to case study number 2 of a real life situation. He was 73, a retired engineer. She was 66, a retired office manager. Their normal taxable income, including 2020, was 100,000. But he wanted to do 100,000 Roth IRA conversion. He also wanted to recover tax when he had a banner year in 2019 and had 152,000 of income. And finally, they wanted to earn a higher cash flow in retirement than what the banks, bonds, and stock market dividends pay. So here's what we actually did. They bought 2 solar reefers, 60,000 each. And of course, now taxable income is not 100,000, but 100,000 plus an extra 100,000 from the Roth IRA conversion. If they did nothing, they would owe 36,159 of federal tax. But because of the 2 reefers and taking Section 179, they get to deduct 104,400. That lowers their taxable income by more than half. If we didn't have a tax credit, they would owe 12,612. But now they have 31,200 of solar tax credits. So they wind up owing 0 federal tax in 2020. And what do they do with the extra 18,588 of solar tax credit? They can go back 1 year and recover all the tax they paid when they had a bumper year, 152,000 of income in 2019. And we still have some solar tax credit left over. We can carry forward and apply it to the next year, 2021. So the way the law works, when Jimmy Carter was president, you first had to reduce his tax in 1976 to 0. If you still had extra tax credits and deductions, you could go back 3 years and recover up to all the tax he paid 3 years before getting elected president. If you still had extra tax credits and deductions, you could carry forward and use it in the next 7 years. The way the law works today is I first must reduce your 2021 federal tax to 0. I can only go back 1 year to 2020. So if I reduce your 2021 federal tax to 0, I can only go back 1 year to 2020, and I can recover up to all the federal tax you paid for 2020. If I still have extra deductions or credits, I can carry forward, and I have up to 20 years in the future to use it. So let's now look at the rate of return for this client. They saved in 2020 36,159 of federal tax. They recovered up to 18,588 of tax paid in 2019. So that totals 54,747. So their net investment drops almost in half. Their annual income is 7% of the 120,000 or 8,400. And so the rate of return is actually 12.87%, not counting the Arizona income tax saved. But if we add that, now the rate of return is typically 14%. So basically think of it very simply. If I buy 2 reefers and wrote a check for 120,000, but I save 60,000 of tax, instead of earning 7%, I'm really earning 14%. And again, if you want to save tax, I don't care what your scenario is, whether you just sold a rental house you inherited and you netted 300,000, just come in and call me 480-706-0177, and I'll show you different alternatives like this equipment leasing where you can earn a 7 to 10% plus cash flow, reduce your taxes, and have a lot more money for retirement in your bucket list fund. Or, of course, you can go to calendly.com, click on the link, book a time, and we'll spend 45 minutes together, absolutely no charge. At the end of 45 minutes, we decide we need more time together. Come on into my office and we'll spend an hour, 2 hours together in my Tempe office at no charge. Now, if you do nothing to your traditional IRA and 401k, you're going to let the IRS hurt your kids or grandkids. If you've accumulated 300,000, 500,000, a million or more in these tax deferred accounts, and unfortunately the drunk driver hits you the wrong way, drunk driver, you and your spouse are dead, that million will gush out and it's all taxable to whoever gets it, your kids or your grandkids. Let's go to case study number 3. This is not a high income couple. She's already retired as a bookkeeper. He's working, selling premium windows and doors. Normally he makes about $85,000 a year, but in 2020, due to coronavirus, he made significantly less. And they said, okay. I met them at a seminar June 15, 2019 in Ahwatukee, which is an affluent area just between Phoenix and Tempe, Arizona. I set up a private pension for each of them. She's going to wait about 5 years to trigger it, and she's going to get $22,097, and that's about a 9% rate of cash flow compared to what we deposited. Far better when you get from banks, bonds, stock market dividends, and the principal's safe. If the stock market drops, she doesn't lose a penny. So we took that out of the stock market, and they were so happy. A year ago, when coronavirus pandemic occurred, it only took 5 weeks for the stock market to drop 30%. And then a year later, in 2020, I said, let's take a look at your taxable income because you earn less as a window door salesperson. I said, okay, fine. After your deductions, you have about 48,000 of taxable income. Let's now turn that private pension and that future 22,097 from taxable to tax-free. So they do a 252,720 Roth IRA conversion, which almost everyone's afraid to do because they don't want to have 252,720 of extra taxable income. But because of the solar reefer strategy, they pay no tax, no federal tax in 2020 on over 300,000 taxable income, and they've got 252,720 of her traditional IRA private pension. Now it's a Roth IRA. So when she triggers her income in 5 years, that 22,097 is tax-free for the rest of her life. Who wouldn't want tax-free income, especially when you're retired? Now, you decide how much you want to pay in taxes or how much you want to keep in your family. Again, it's knowing the tax rules. I don't do anything crazy. We use the same rules that President Carter used when he got elected president of the US. We use the same rules that Governor Reagan used when he was multi-term governor of California. We use the same rules that these giant companies like Whole Foods and Amazon use to make billions of profits and yet pay no tax. And they shouldn't be ashamed. They're creating hundreds of thousands of jobs, and better machinery makes the workers more productive so they can pay them. And they've been giving them substantial pay raises over the last 2 to 3 years. Now, people see me for a number of reasons. We spent a lot of time in this webinar about taxes, but it's 2 other reasons. It's about how do I maximize my retirement income? When people come in, I say, okay, how much are you spending now? How much do you want to spend in retirement? And how much do you want for bucket list items? A lot of folks have come in, never thought they could afford bucket list items. And a bucket list, just like the name of that movie, is everything you ever dreamed of. The most common 2 bucket lists are, I'd like to travel, either foreign travel that I've never done, or be able to see my grandkids 3 or 4 times a year. They're scattered all over the US. Or it's to help my grandkids with some of their college expenses. And I say, how much do you need? Typically, they say if I could just get 10 or 15,000 a year more, I'd be happy. It is not unusual if you give me 5 to 7 years for the plan of work that I can get most people 30,000, 50,000, in some cases 100,000 more retirement income than what they thought was possible. And now they are extremely happy. So the first reason people see me is to maximize retirement income. Second is to reduce Wall Street risk. In other words, when you're retired or 5 years from retirement, you can't recover if the stock market crashes and you lose 20 to 50% of your life savings. And remember the dot-com crash, the NASDAQ index, high tech stocks went down by 78%. The 2008 2009 crash, the stock market dropped by half. A year ago, the coronavirus panic, it only took 5 weeks for the stock market to drop 30%. So the easiest way to avoid stock market risk is not having a lot of money in the stock market. Think of it. Would you take your retirement savings and go to your local casino and push all your chips on a roulette wheel on red or black? No, you wouldn't. Because if you lost it, you'd never be able to make it back. And the third reason people see me is to reduce or eliminate their income tax. And when I talk to dental conventions, their number one goal for physicians or dentists is to be able to retire 5 to 15 years earlier. Now, typically a dentist, whether you're a general practitioner or a specialist, has to work until 70 to retire to pay off the student debt, the debt. Maybe they had to borrow 800,000 to buy their dental practice, and it takes forever to retire. But I simply tell folks, look, you've done whatever you've done, maybe decades of school to get into profession. You've got decades of experience by the time you're 55, 65, 75, the typical ages when people see me. And I can't change what you're making in income, but I can take care of your taxes. So for a typical high income couple, such as a dentist or even a single dentist, if I can just save 50,000 a year of tax in 20 years, that'll be about 2.5 million more in your retirement account. So who couldn't retire 5, 10, 15 years earlier, particularly in low cost Arizona, if you had an extra 2.5 million in your retirement account? Now let's suppose you're not paying 50,000 a year of tax. You're paying 10,000 a year of tax. If I can save you 10,000 a year of tax for 20 years, guess what? You'll have an extra 500,000 in your retirement account. And maybe you would have saved 500,000 by yourself. Now with an extra 500,000, now you've saved 1 million. And at that point, I've got a number of options where you can get a 7, 8, 9% cash flow. So let's put in the middle at 8%. So you've had an extra 1 million saved up by retirement times 8%, 80,000. You waited till full retirement age, 66 or 67, or even 70 to maximize your Social Security. And now you and your spouse have at least 50,000 Social Security, 80,000 other retirement income. That's 130,000 a year. And hopefully by then your house is free and clear, your car's free and clear, you have no debt. I mean, who couldn't live in low cost Arizona on 10, 11,000 a month? Anyway, so you have a choice. What future do you want? Do you want all of your life savings in the stock market where at any point you can lose 20 to 50%? Or do you want steadier growth without having to fear a next stock market crash? And finally, we've got case study 4. This is something that almost no one has ever seen. When I got my doctorate in economics at Berkeley, economists have something called the economic cost. It's not just saving this high income client 40,000 a year of tax times 30 years or 1.2 million of tax. It's if we save you 40,000 a year of tax, what could you have earned on that 40,000? Again, this client says he can earn 10% rate of return without stock market risk, and I've got some options. So if he earns 100,000 a year on the 1 million in the Roth IRA, and it's all tax free, he saves 40,000 a year compared to if that million was in a traditional IRA or 401k, because now that 100,000 would be taxable times 40% would be 40,000 a year taxes. But what could he earn on that 40,000 a year now that he's not paying in taxes? You take the standard Hewlett Packard 12C financial calculator, and here's the keystrokes. For payment, it's 40,000 a year of annual taxes saved. I is the rate of return of 10%. And let's use a 35-year horizon. Remember, it's not just his life or his spouse's life, but for the first 10 years, the kids get it. There's no tax as well. So if they're around husband and wife for 25 years and 10 years for the kids, that's 35 years. Now, the economic operating costs of investing 40,000 a year, which is annual taxes saved for 35 years, is just about 12 million. So let me ask you this. Is there any logical reason you would not want to add almost 12 million net wealth to your family? Again, we know not everyone has $1 million, but most everyone has saved 200,000 after a lifetime of work. So if we converted 200,000 to Roth, well, that's 20% of 12 million, or almost 2.4 million. Is there any reason, any logical reason you wouldn't want to add 2.4 million net wealth to your family to help you, your spouse, your kids, and maybe even your grandkids? If you've got an extra 2.4 million, believe me, you can afford all sorts of bucket list items. Now, I promised I'd tell you how to handle Whole Foods. Whole Foods believes in clean energy. You can see the ads by Amazon, by the way, that they run millions of dollars of TV ads by them. And Amazon, remember, bought Whole Foods for $13.7 billion in 2017. Whole Foods is just up their back order, and they've asked, how soon can you deliver and manufacture 400 solar reefers? And these will be on a cash sale basis. But again, remember, 26% solar tax credit, Section 179. Whole Foods will be able to save 10 to 20 million of tax. But more importantly, our solar powered reefers have 3 times the coefficient of performance of a diesel powered reefer, which cannot keep up when it's super hot, 90 degrees in the southeast, Florida, Georgia, Alabama, Mississippi, Louisiana, and 90% humidity, or 110 degrees in Las Vegas or Phoenix and low humidity. A diesel powered reefer just can't keep up and cool enough. We blow as cold as 48 degrees below zero. And also, Whole Foods will cut diesel bill. They'll cut their diesel bill in half, and the diesel pollution is what kills folks, particularly when combined with coronavirus. So now, happiness is not worrying about money. You want to be able to provide for yourself, your spouse, your kids, and your grandkids. It should all be about enjoying life, and that's the goal of my clients, to never have to worry about money. So here's the key questions you got to ask yourself. Do I want to pay lots of tax or zero? Do I want a higher retirement income than what I can get from bonds and dividends? Do I want to reduce stock market risk? Do I want to convert my IRAs and 401ks that are forever taxed to Roth IRA that are never taxed? And how important is it to never worry about money in retirement? So again, just call me at 480-706-0177. If you leave a voicemail, because I do have to sleep at some point, so I turn off the phone, just be very clear. Spell out your name. Don't count on the fact that I can understand you when you speak quickly. Leave your phone number twice and spell out your email address, and I'll get back to you and we'll schedule a time. Or you can go to mycalendar.com link and let's schedule your free strategy session. And I'm so confident I can save people tax. When we get together for your live strategy session, which can be 1 to 2 hours in my office, if I can't reduce your taxes by 50% or more, I'll pay you $300 for your time after your free live strategy session. And bottom line, wouldn't you love to retire early and happy without taking Wall Street risks? At this point, I believe we have a number of questions. Susan Ratliff is my education chair, and she's helping me out by monitoring the questions. And we've had some questions posed to us before the webinar even began. Susan?
Thank you, Harold. That was wonderful. I learned a lot myself. I have one question to start with from Dave. He wants to know, how many units can I invest in per year of the solar reefers?
Well, the only limit is how many we can manufacture. Again, most people, if their taxable income's 2 to 300,000, generally only need 2 solar reefers a year to wipe out their tax. Now they may add an extra one if they want to recover taxes paid previously. Uh, Again, we are the only ones in the world that have invented this. California Air Resource Board governs the air quality of all 40 million people in California. In numerous meetings, public meetings of the trucking and food industry over the last 3 years, they have stated publicly, we are the only zero emission technology that's commercially viable. So there are only 3 reasons why people might want to be interested in the solar reefers. One, save lots of tax. Two, to effectively make a 10, 12, 14% rate of return safely for 10 years. At the end of 10 years, you get your original money back. Or third, to be part of the practical Green New Deal. And I mean practical. I don't know if there's global warming. I don't know if mankind can control that, but we do know fossil fuel pollution can kill you, and it leads to 43% of all the deaths from lung cancer, 25% of all the deaths from stroke and heart attack. And for these giant food companies with our technology, because they will not have to buy any fossil fuels, any diesel for the reefer, we can cut their diesel bill in half. And we're also going to go beyond that. We're going to take these food distribution centers off the grid. In California, over the last 2 years, when they have these wildfires, because Pacific Gas and Electric, the largest utility company which covers Northern California, was hit with $17 billion of fines and lawsuits because they claimed that one of their old wires sparked and started these giant wildfires. Guess what? The next time a fire occurs, they just turn off the electricity and they got rolling blackouts. Imagine if you're a food distribution center, you've got $50 million of frozen food and meat and dairy. So we're going to take these food distribution centers off the grid, turn them into solar farms. And California Air Resource Board estimates medically, if we do that, we will reduce the chance that the employees at these food distribution centers or grocery stores will reduce the chance they get lung cancer by 95 to 98%. So this is huge purely from a medical viewpoint. So
yeah. There really is no restrictions to how many I can invest in a year.
The only restrictions is how many we can make. If you asked us a year ago, our goal for this year was to make 350 to 400, but California's already asked, how soon can you triple production to 1,000? In the next 2 months, we're adding another manufacturing facility that's on 3 acres. We'll be able to triple production. And then California's asked, how soon can you triple from 1,000 units a year to 3,000? How soon can you double again to 6,000? You see, there are 50,000 diesel-powered reefers that remain in California. There's over 100,000 diesel-powered reefers that drive into California, such as warehouses in Reno, Nevada, drop their load and then leave. Under California's clean energy plan, by 2030, half of all electricity must be clean energy, and there cannot be a single diesel-powered reefer anywhere in California. So we, in the next 10 years, have got to replace 50,000 diesel-powered reefers. And by the way, it's not just our industry or food industry. Starting in January 2020, any new home built anywhere in California must have solar on it. And by the way, the new home industry is way bigger than the reefer industry, because imagine how many new homes are built every year to house 40 million people in California.
Dr. Wong, do your strategies work for people who are already retired?
Absolutely. We have clients that are absolutely retired. In fact, last year, we had a lady who was 80, and she and her husband, unfortunately, had suffered from dementia, and they went to some seminars I gave for the Dementia Society of America. I co-wrote the book, 2020 Arizona edition. It's called Don't Go Broke, Paying for Long-Term Care. And she didn't have a super high income, very comfortable, however, more than enough for them, but she believed in solar. For 10 years, she's had solar on her own personal house, saving lots of energies. So she was just interested into solar reefers for two reasons. One, to earn effectively a 7% uh, income where you don't pay taxes on it, because instead of taking Section 179, the big tax write-off upfront, she just simply depreciates over 10 years and she still gets the 26% tax credit. And also to be part of the green revolution because she absolutely believes in solar. So yes, you could be 75 years old. She was actually 80, or you could be someone much younger, 50, an engineer, and your spouse and you earn a lot of money. Two engineers can make 250,000 together. Or I had a recent client that bought 4 reefers. His wife is a pediatrician. They're young, about 52 years old, and he's an engineer. And as a pediatrician, she says she truly understands how pollution can affect the health of babies and also young kids, and in fact can kill them. And certainly when coronavirus occurred, what happened if you had a comorbidity, you were overweight, diabetes, asthma, then coronavirus hit, and then it killed you. So there's a connection between coronavirus and all these other things that affect and weaken your lungs.
So can you really double retirement income compared to what somebody would think they would have? You can really do that?
Absolutely. I'll give you an example. Debbie was a nurse, uh, a psychiatric nurse. About 7 years ago, when she was 62, what we did is we deposited 270,000 in a private pension. And I asked her to wait 8 years until 70, not retire to 70, that way to get maximum Social Security. It turns out she was tired of her job. She was, as the assistant chief nursing officer, was responsible for 300 of the 600 employees in this Arizona hospital. And the patients didn't give her a problem, but having to keep track of 300 employees, boy, that was a nightmare. So she did retire 2 years early, but what she did is I had her increase her retirement income by buying back. For the Arizona State pension, you can buy back. She had service in Alaska just as a cook for during firefighting season for the Bureau of Land Management. I had her buy back 4.5 years. She worked 10.5 years for the state. So when she retired, she had 15 years of service. And so she got about 30,000 a year from that. Social Security, which she waited till 68 to take, 2 years earlier than originally planned. That was about 30 to 31,000, and she will wait until 70 to trigger her private pension, and that'll be 27,000. So her total income is 87,000, and she actually makes more net than when she was making 100,000 a year as an employee. Because as an employee of the state, between Social Security and paying in the state retirement, you lose 20%. So 20% of 100 grand would be 80,000, netting with 80,000 before income tax. And now she'll have 87,000 before income tax. And with these strategies, we can offset her tax as well. So yes, by the way, that private pension throwing off 27,000 a year, by depositing 270,000, waiting 8 years, 27,000 a year is a 10% rate of cash flow. It's 5 times the 2% you would get from dividends or loaning to Uncle Sam by buying a 10-year treasury bond.
So if
People are
someone,
truly amazed that these strategies exist. All you have to do is call me and let's put them to work for you.
yeah, you can give a personal consultation at no charge. Just call Dr. Wong at 480-706-0177. We have a lot of questions, but not any more time to answer them, Dr. Wong. So I urge everyone to go to your Calendly link and book a consultation with you, or just give you a call to get their questions answered and some personalized service to deal directly with their issues and income.
And
Thank you so much.
absolutely, I look forward to it. Again, I consider the clients and the million plus people I've educated through my newspaper columns and 400 TV radio shows. I consider all of you as like my extended family. And if I was the head of family, I would have to protect you against the dangers, losing half your life savings to the stock market, not having enough retirement income, paying too much taxes, and not having money for unexpected medical or long-term care expenses. So be part of my extended family and take advantage of the 50 years I've spent researching the world of money.